Good evening, all. Today we might gonna discuss the D-shaped group. D-shaped group, or sometimes we refer as a mixed group. A D-shaped group exists where parent. Parent company has both direct and indirect ownership interest in a sub-subsidiary. Again, the effective group holding in sub-subsidiary is important when preparing the consolidated financial statement. As introduction, the following group structure as a D-shape. The parent hold 80% of the S. The S hold 75% of the SS. This means when the parent's perspective SS is a subsidiary, it is a direct, not a direct, indirect ownership. And meantime, the parent also hold 10% in the SS, that is the direct ownership. That is why here called as a parent has both direct and indirect ownership in subsidiary. So with that, not in this example, SS is a subsidiary of P with a additional shares held directly by P, right? I think that's clear. Then NCI, in this case, the D-shaped group, the identification of the NCI is a key. Think about the NCI example above. P acquired 80%, and P acquired 80% of the S. The NCI of the S is 20%. The remaining 20% is the NCI. Here, you can see the P acquired 80% of the S, but X acquired 75% of the SS. In that case, the NCI is, the direct NCI is how much? 80% into 75%, that is 60%. The effective holding, 80% into 75%, 60%. Right. It means here you can see in this structure above, the non-controlling interest in S is 20. The non-controlling is in S is 20. The direct non-controlling interest in SS is 15, right? Right. The indirect non-controlling interest in SS is 20% into 75, 15%. The indirect non-controlling interest in SS, right? 15%. The non-controlling interest in SS, therefore 30%. How the 30% is came? Because the parent, the effective holding is 80 into 75%, that is 60% plus 0.1% direct holding. It means we have 70% holding and remaining 30% goes to the NCI, right? Right. The ownership of SS, the group indirect holding 80% into 75, that is 60%. I told you that group indirect holding 10%, remaining to 30% goes to the NCI, then you can get the 100%, right? The consolidation procedures in respect of D-shaped group at the same those case as a vertical group. Establish the effective holding in SS, therefore the NCI. In the goodwill working, the cost of investment in SS include the cost of P's investment, the direct investment. So we can recognize 100% as the direct investment. P's shares of the cost of S as the indirect investment. Since this is a P acquires 80% on the S, in such S investment also you can recognize up to 80%. That in that case, right? In the NCI working, the NCI share of cost of S investment in S is deducted from the NCI. So that is why we are, let's assume in order to acquire 75% of the S made a 10,000 investment, 10,000 million investment. In that case, we are recognizing in the cost of control account 8,000. It means 10,000 into 80%. Remaining 20% we need to deduct from the NCI account debit, and the cost of control, investment account credit need to be credit, right? That is why it's mentioning. Calculation are based on the group NCI effective shareholders, right? Shareholding. The following example is given. Hulk H. Mall Hill and the Pimple Co. as the 31st May 2015 as follows. H, M, and P. We have assets, non-current asset, tangible assets we have. The investment in subsidiary. So the shares in Mall Hill. So in order to the H acquired M, we can recognize this 90% as 90 million as is it. Shares is Pimple, we can recognize this 25%, but we can't recognize this 42% at once because we need to take the investment. It means 60% out of that we can recognize, the remaining 40% goes to the NCI account, right? The current asset also there, the stated capital also there, revaluation surplus are okay, retained earnings also there, the non-current liabilities also there, current liabilities and the payables also there. The adjustment is there is no impact in, no impairment in goodwill. So we don't bother about that adjustment. There is no payment of the dividend by either M or Pimple since that they become subsidiaries. We don't bother about it. It is the group policy to measure the NCI at the acquisition at the proportionate share of the fair value of the subsidiary net asset. That is key important because the NCI, we know that in the consolidation, we can use either a fair value model or the proportionate net share basis in order to calculate the NCI holding at the date of acquisition. So I think that's, you know, that under the basic consolidation or in the BRT subject, we learned that those things, right? Right. With that, the Hulk is acquired a 60% of the M. When the retained earnings stood at 8 million credit, the Hulk acquired 20% of the Pimple Co. And M is acquired 60% of the Pimple Co. when the retained earnings stood at 15 million, right? 15 million. This is a D-shaped group structure because the parent is holding a direct interest in the subsidiary, and subsidiary also made an investment to acquire the subsidiary, right? So the required to prepare the consolidated statement of financial position. So I think these kind of things can be tested in your exams. I saw that the 2 to 25 marks they're testing. Right. So with that note, we can start the consolidation working. Firstly, we want to identify the NCI as well. So the group structure, the Hulk has acquired 60% of the Molehill. It means the NCI direct is 40% in the M, and M acquired 60% of the Pimple. So the meantime, the Hulk acquired 20% of the Pimple, that is the direct investment. Effective investment in Hulk by Pimple 60% into 60% into plus the direct investment 20%, 56%. Remaining goes to the NCI shareholding, right? I think that's clear for you all. Right. So I'm not going to discuss the group share is 56%. You know that the remaining 44% is the NCI. I'm not going to repeat. Repetition is not required. The consideration HM. This is the parent and subsidiary. Sorry. Yeah. Parent and subsidiary. 90 million. The consideration transferred. 90 million. Right. You can sorry, not here. In there, you can recognize 90 million as it is. And you want to take the pre-acquisition profit share. In here, the retained earnings is 8 million. Retained earnings is 8 million and stated capital is 50. So you can take 50. 58 then. 58. Share capital and the retained earning 58. Out of that, you can take the NCI as a 58 into 40%, that is 23.2. Then you can get the goodwill in subsidiary. But meantime, you want to take the goodwill in SS subsidiary as well. So the direct investment you can recognize at once. Direct investment, that is, I think, 25 and 42 into 60%. Right? You can't recognize 100% as it is. 25 you can recognize, 60% into 42, that is 25.2. And the NCI also, you have a 50 million share capital and the 15 million return earnings. The reserves here, it's mentioned that reserves it's 50 million and stated capital again it's 50. You can take and into the 44% is the NCI. I think it's clear, eh? 44%. Here 65 into 44, this can take, and after that you are ended up with 13.8 million. So altogether the goodwill is 69 million. So please remember that when the remaining 40% goes to the NCI, we are debiting to the NCI, it means 42 into 42 into 40%, that means 16.8 we are debiting to the NCI. That investments belongs to NCI. Here you can see 16.8. The investment account credit, and the NCI account is debit. Harine, 42 into 40%. 16.8. I think that is clear, right? So I'm not going to repeat again. So our adjustment is done. The tangible asset you can line by line just addition, and the goodwill is we done, and the investment, so we don't have such amount, so we don't have current asset, just line by line addition, no need to buy hard. Stated capital, so you only have the parent investments, the parent stated capital, not the investment, the parent stated capital, the revaluation surplus. So you want to 50 plus 20, 50 plus 20, the revaluation, but you can't take that is because the 50 is belongs to the parent, but 20 that is need to be, that is post acquisition. So you want to deduct 40%. It means 20 into 40%. That means 8 into NCI holders. That is why we are debiting to the NCI here. The net impact is here 8. The revaluation surplus debit, and the NCI account is credit, that belongs to the NCI shareholders because we want to distribute among its group and the NCI. Right, that is why here it is minus 8. The retained earnings 45, 32, 25. That is the balances is stood at this SOFP. Balance is stood at SOFP. That is this here, the line by line just addition. 45, 32, 25. Out of that, my dear guys, you want to deduct the 8, that is the pre-acquisition. 8, I think that is no, 8 and 15 million, you want to deduct it. 15 million, here you can see that. And 40, why is that 40? Adjustment number, go to the adjustment number 3, working number 3. Working number 3, the retained earnings and revaluation surplus, 32 minus 8 into 40% is 9.6. That goes to the NCI holders. 9.6, here you can see here. Right, the NCI also we discussed at this amount to 23.2, 23.2, here you can see 23.2 and 28.6, 28.6 here, 28.6 and 22, how the 22 came, 22 the post acquisition profit, right? The post acquisition profit, how it's derived, the 32 minus 8, 32 minus 8, 32 minus 8, the remaining out of 40%, that is 9.6, right? 9.6. And I think there the 25 minus the pre-acquisition is 15. Out of that, the 44%, 4.4 and 9.6 altogether, we have 40. 14, that's why it is written 14 here. Debiting 14. Credit to NCI 22. The net balance is 22 here, right? The loan is just line by line addition, and payable also just line by line addition, and you can go. The crucial one is in here, goodwill, and here and the stated capital. No need to bother. You are recognizing only parent portion here, and the revaluation surplus and the retained earnings and NCI. That is the most crucial things. So if I'm showing you the balances, how came the balances, the revaluation surplus again 50 plus 20, but you want to transfer it into the NCI account, and again you want to distribute 14. How this 14 came? I'm asking from you all how this 14 is came. I think it's visible. I think this presentation is visible to you. Here you can see the 32 minus 8. 32 minus 8 into 40%. 32 minus 8 into 40%. That is 9.6 plus. Again, you have 25 minus 15 into 44% NCI. Again, 4.4, 9.6, altogether 14. That's why the retained earnings is debiting 14. Right here, you can see the retained earnings is debiting 14 here. And the stated capital, revaluation also debiting 8%, and that is goes to the NCI because that portion is belongs to NCI holders, right? Right. Then what is this 16.8? You can see, I think I remind you that the investment, the remaining 40% goes to the NCI. We are debit to the NCI account, right? It means the 42 into 40%, 42 into 40%, that give me 1 minute, right? 16.8 need to be debit to the NCI and credit to the investment account, 16.8. I think that also clear to you all. Then you can get the balances. I'm not going to discuss everything. So that is the end of this question again. That is, I told you the post-acquisition revaluation 20 into 40%, 8 million. The post-acquisition profit 25 minus 15 into 44%. That is after effective only remaining 44%. The required entries retained earnings should be debited by 14 million. The revaluation plus debit, NCI is credit. That is why this 22 million is came. I did explain you how this 22 million is came, right? This 22 million is came. Again, you have, if I'm not mistaken, this NCI is debiting and the investment is crediting. That is the end of this question. These type of questions can be tested in your exams. I saw that in past paper, this question is tested for 20 marks. If you are getting the methodologies in a logical manner, you can definitely score the 25 marks out of that. So that is the end of this question, and thank you all.